Welcome everyone from lunch. So this panel is the role of banks and macroeconomic conditions on climate finance. I'm David Brown. I'll be moderating this panel. I'm a faculty member at Fuqua and also the faculty director of Fuqua's Edge Center. I'm delighted to have two fantastic panelists here today. Leslie Biddle, Senior Advisor to the Undersecretary for Infrastructure, U.S. Department of Energy, and Melissa James, Vice Chairman at Morgan Stanley. If I were reading your bios, that would take up half our time, so I'll just kind of dive right in. But thank you so much for being here today. I know we're all going to learn a lot from this conversation. So, in broad strokes, what this is about is thinking about more mature companies, closer to IPO or maybe even public, and thinking about the financing environment that they're facing, and thinking about the macroeconomic conditions they're facing and the regulations they're facing. And I want to get your perspective on that. And it was interesting to hear exits come up in the VC panel, and I think this is very relevant, thinking about if you think about going public as a desired end game for many companies, the conditions in that environment has implications earlier on in the life cycle of all companies. So I want to talk about market frictions and policy solutions, kind of recurring themes we've talked about today, your perspective kind of coming from the banking perspective, and then also some specific topics that I'm excited to dive in on. So banks, macroeconomic conditions, let's start with kind of the obvious here. That would be interest rates, right? And so there's been a lot of discussion, concerns, probably understandably so, about the high interest rate environment and how that affects, access to capital, given the high upfront capital costs, associated with climate technologies. And so give us your perspective on this, how you see this financing environment affecting the flow of capital into climate technologies, particularly as we're thinking more mature companies closer to IPO. And so I'll open that up. Either one of you want to get us started on that?
Okay, yeah, so happy to. Well, first of all, thank you so much for having me. It's wonderful to be here. Interest rates play a critical role as it relates to the clean energy landscape because as a general matter, anytime you have a high growth company, interest rates are going to affect the valuations of those companies and those companies' access to the capital markets for a myriad of reasons. And generally speaking, there's an inverse correlation between interest rates and valuations. So the higher interest rates are, the lower valuations are. If you think about it from a discounted cash flow perspective, if you have a company that is a high growth company and it has its cash flow profiles very back end weighted, those higher interest rates, when you're discounting those cash flows to value the company, those higher interest rates actually have an even more significant impact on the valuation of the company. So that's one reason why higher interest rates affect the valuation of these companies. The other thing is, if you think about why you have a higher discount rate, you have a higher discount rate because investors, generally speaking, have higher hurdle rates in a higher rate environment because they have more competing investment alternatives that can offer a better risk-adjusted return. So that's the reason why you generally speaking have a higher hurdle rate or discount rate when you have these kind of projects. And then thirdly, you mentioned it, David, that these companies are very capital intensive, and so they need to borrow. They can't just always, for their life, be equity financed necessarily, or that's a very expensive source of financing. So, investors who are looking at these companies are looking at the need of these companies to borrow money in the capital markets at some stage in their life cycle. And the higher the interest rate environment, the more costly their debt is going to be, and that's going to have an impact on earnings. And then the last thing I'll say is that, depending on why interest rates are high and what your outlook is for the macroeconomic environment, if you think that, if the Fed is tightening and making monetary policy more restrictive because they're trying to slow the economy, then that's going to affect business investment and consumer spending, which in turn can also depress the earnings of these companies. So for a variety of reasons, the macroeconomic backdrop and absolute level of interest rates absolutely affects the prospects for these companies. And we saw it in spades really in 2023 when equity issuance for clean tech companies was down about 60% relative to 2021.
Leslie?
Yeah, and as you know, the bipartisan infrastructure bill has infrastructure in the middle of that, and these are very large capital-intensive projects. And this is most of it, late-stage infrastructure that does rely on the debt markets significantly. And when you think about going from billions and catalyzing that into trillions, if you think about the cost of capital and the impact on the cost of the consumer to finance the transition, it's meaningful. And so, we have a lot of tools in our tool belt with the Inflation Reduction Act and the Bipartisan Infrastructure Bill. But when you have a higher cost of capital and you have the higher risk premium that Melissa just talked about, those tools become incredibly important because we are looking to buy down the risk, and we are looking to make this more affordable for everyone in the economy.
Okay. Yeah, so what I'm hearing here is, yes, this is a concern, but we've got some policies, and that was one of my next points here, is that, supporting this and kind of counteracting this effect. Let's talk about another friction, okay? Banks face a lot of different risks, right? They face market risks, liquidity risks, operational risks, climate risks, which we're going to touch upon here in a few minutes, credit risk, okay? This financing environment, that inevitably means that lower credit quality firms just have tighter constraints, and they don't have the same access to debt that they did before, a few years ago. And so how do you see this kind of taking shape? Are these firms becoming less important in driving innovation? Is this a problem in your view? And again, whoever wants to get going on that one.
Yeah. Well, I guess the way I think about it is that it is the case that companies that are larger and more established and higher credit quality and may have unfettered access to the capital markets have a competitive advantage in that regard, right? But I don't think that means that the smaller, lower credit quality companies are less important necessarily. The reality is that you need the large, big incumbent companies just like you need the smaller disruptive companies. I think there's a role for both players to play and in the ecosystem of affecting the transition. A lot of these smaller companies, as was talked about earlier at some of the sessions, are very agile. They can innovate more quickly. They don't have to retrofit existing processes. And so, you take the electric vehicle manufacturing sector as an example, right? You've got all the OEMs that are basically trying to electrify their vehicle fleets, but then you've also got, the new entrants like Rivian as an example that was mentioned at one of the panel discussions, where they're coming in and disrupting essentially the truck and SUV sector of the market. And we took Rivian public back in 2021, and then in 2023, actually, Morgan Stanley raised $3 billion of convertible notes for those for Rivian in two separate green labeled convertibles. We did a $1.5 billion deal for them twice in 2023 in this more constrained environment. So it's not to say that companies don't have access in a more restrictive credit environment. It just may be on different terms. The other thing that I would say is that, one of the developments that's happened in the capital markets of late is, there's been tremendous growth in the private credit markets, right? So private credit has really exploded. If you look at basically, the assets under management in the private credit, they've grown at like a CAGR of close to 15% over the past 5 years. So now there's something like an estimated $1.3 trillion of private credit that is under management, and that number is expected to more than double by 2028. So, and if you think about how much of that capital is actually committed and waiting to be deployed, we estimate that there's something like $500 billion of dry powder effectively in the private credit sector to be invested. And I think private credit can play a really important role in the energy transition. And in point of fact, many private credit platforms are very focused on investing in energy transition. So like take Blackstone as an example. They have a platform called the Sustainable Resources Platform. They launched it in 2022. They mentioned, in the press release that they saw $100 billion of investment opportunities across their platform, in clean energy transition specifically. So, I think that private credit will hopefully be there to, catalyze and that's a lot of the private sector capital from a lending perspective.
Yeah, and I mean, as you look at the projects that are occurring now, obviously the startups, the innovators, they have a huge role in the transition, but we also are transitioning the incumbents. And they do have balance sheets, and they do have goals, and they are eligible for many of the tax incentives. So while what happened, and you have interruptions in markets and throughout at all times. And so even when the markets tighten up for some of the newer technologies, which I think we'd all agree that this is a moment in time where the markets are a little tighter, we still have a huge amount of investment opportunity as it relates to the incumbents, as it relates to really not only what we're going to replace, but how we retrofit what's here. Those are very much, qualify for many of the incentives And we're seeing, if you look at the named projects that we have coming out of the Department of Energy, a lot of those are, the Coca-Colas and the Shell oils and the what have you that are actually taking, and they have the balance sheet and they have the capital that's necessary to make this transition. And so it's kind of like, we need all the pieces. We need all the pieces.
Okay, well, thank you. So this is really interesting. The private credit is really interesting. That's kind of, in my view, kind of a market innovation. I know that came post-financial crisis. What I'm hearing is a general kind of sense of, yes, there are choppy waters, but some optimism conditioned on appropriate regulatory support. So let's pivot to that. So I want to ask about regulatory measures and policy innovations you think will incentivize banks and other large financial institutions to make investment in lending decisions that are environmentally friendly. And maybe we could start with taxes. That's at a point that's come up a few times. Tax credits are a big part of the Inflation Reduction Act. So I don't know, Leslie, do you want to kind of take that first on that point?
Yeah, sure. I mean, obviously, the tax credits, and John Podesta mentioned this, like it's a primary tool we're using, right? And so we have to think about the tax credits in the regulatory framework as it relates to the financial institutions as well. So obviously there's a lot going on with Basel III Endgame, and how do you take, how much do you provision for tax credits? How could that facilitate or not?
Can we give the audience a little bit about the Basel III?
Sure.
Very quick, yeah.
So Basel III is basically the framework for risk on banks' balance sheets. What do they have to provision for? How do they have to risk weight of certain assets to ensure that the banking system is strong? And coming out of the financial crisis, but also just even this last summer, and my dates are, going into Silicon Valley Bank, there's a constant need and need to look at the way that financial institutions account for assets or provision against assets on their balance sheet. And Basel III Endgame is the current construct which the Fed and U.S. regulators are playing into or are feeding into, and it's a primary European construct. That has a provisioning for the way you must account for tax credits on a bank's balance sheet. And historically, that's had a risk weighting of 100% provisioning, and the current rules have you go to 400% provisioning. And that, while many of these tax credits, again, as John mentioned today, are direct pay, and there's being used by corporates against their corporate income tax, there's still a large role that some of the primary financial institutions play on holding these on their balance sheet. So when you think about how you are really catalyzing, again, billions into trillions, you have to not just think about it from the lens of what is happening in the energy transition, but what are all the pieces that are that need to be supportive of that, and how the banks are regulated, what the banks get kind of credit for or not, actually is a spigot that we need to pay attention to. And right now, it is a moment in time where people are talking about that, and when it's such a primary element to what we're using as the tool in our tool belt, it's important to focus on.
Yeah, no, I mean, I completely agree with what Leslie said. I think, one of the main things, the tax equity markets are a big component of what is going to finance the energy transition, because it's sort of like you get the double whammy when you make tax equity investments of being able to get a financial return, but then also an impact return in terms of renewable energy credits. And so it's a very attractive instrument or vehicle. There's probably $12 billion of capital every year that's being deployed in the tax equity sector in clean energy, predominantly solar and wind. And so, we want to make sure that capital stays available and grows and doesn't shrink.
Yeah, I mean, so does Basel III have negative implications for the transferability clause in the IRA, or is that?
No, that's separate.
Okay,
I mean,
so that's more company to company.
It has to do, if the banks, if the banks want to hold it on their balance sheets, that's when it has the impact. The transferability,
It's not really used by banks.
You can still, well, the banks can transfer it to end users, or if you are the recipient of the credit, you can transfer it to others who may need the tax benefit.
Right.
So it doesn't impact the transferability. And as John mentioned, I mean, the direct pay element to that, the secondary market that from transferability, like there's a lot of very, very helpful things that are in the IRA that make that a real market. And so you just don't want to see other, I think, well-intended regulations at the banks. Like everyone wants to make sure our banking system is secure, but I don't think the full understanding of how that may impact the transition is fully understood. So it's our job to inform regulators and let them know what the potential impacts are.
Okay. Maybe we can also ask, another point here on policy. A little bit more of a deeper dive, maybe from you, Leslie, first on kind of grants coming from, bipartisan infrastructure law and IRA that are helping to catalyze investment, and kind of how that's working and how that mechanism is working.
Yeah, so again, you guys know the numbers. In the grant side, it's $100 billion of grants. They call it equity or non-dilutive equity, lots of different names, but essentially there is capital going into these projects where there's no expectation of return on or return of capital. So it's incredibly valuable and de-risking in and of itself. And so that is, it's not just a big bucket where the Department of Energy can determine, oh, this is interesting or not. There's very specific kind of rules of the road of sectors that we're looking to incentivize, from industrial decarb to hydrogen, long duration energy storage, et cetera. And those projects are selected based on a very competitive process. And also, to John's point, they must come in conjunction with private capital. So in order to qualify, you have to have at least 50% of the total project cost brought to you by the private sector. So the reason for the structure is to help de-risk. It's to take some of the technology risk, market risk, financing risk, and ensure that these projects that are so important, really the cornerstone of the transition, are able to move forward in a way that is attracting that private sector and really sending the signals what is the most impactful from a decarbonization standpoint. So it's powerful. Jigger's going to talk a little bit later about the loan program, which also has $400 billion and has a massive ability to motivate private capital. But every dollar that we spend on grants, we look to see how catalytic it is. So yes, we say that has to be 50-50, but really projects, when we put in $1 and they're bringing $7, $8, $9 to the table, that is incredibly helpful. And the more we're successful at picking the right projects who come to fruition, the more we think this halo effect, or your ability to put smaller amounts of dollars to crowd in private sector, is really, really meaningful. And so that's what we're focused on. We're focused on picking the best projects that have the most likely chance of success, and to meet all the important policy criteria, such as fence line communities and equitable transition. And we think we're of the $100 billion, we're about halfway through, and we'll have the rest committed by the end of the year.
Okay, great, thanks. So let me pivot to a few questions about root causes of climate change. Primarily we're talking about greenhouse gas emissions, notably carbon dioxide emissions. SEC's proposed greenhouse gas emissions, the disclosure rules, big news. I think we heard some news last week even that they're on the horizon. This has been a discussion for a couple years now, but they're dialing back on scope 3 potentially. Overall, what's your perspective on this? And maybe Melissa, we'll start with you.
Sure. So I think, as a general matter, the market definitely wants and needs more transparency around carbon emissions data. And so the SEC's proposed climate disclosure rules are going to be very helpful in that regard. I think, to your point, the rumor is that they're going to drop the requirement for scope 3. We don't worry so much about the SEC's proposed rules being diluted because, in point of fact, there's other legislation out there that has been put into effect, like what's happening in California, so that whether or not you are domiciled there, if you're just doing business there and you meet a certain threshold, you are required to disclose your scope 1, 2, and 3. And then in Europe, if you look at what's going on there, there's something called the Corporate Sustainability Reporting Directive, CSRD, and that's been put into effect. And a lot of the multinationals and big S&P 500 companies are all scrambling to really make sure that they're in compliance with that, which is much more prescriptive, actually, than the SEC's proposed rules. So you have to disclose all 3 scopes. You also have to basically be subject to limited assurance. I think by 2026, these rules go into effect. You have to start publishing this data next year, so companies are rushing this year to get in shape to do that. And then, by 2028, you have to be able to meet a standard of reasonable assurance in terms of the disclosure of this information. You also have to disclose things like double materiality as it relates to a lot of these, sustainability metrics. So that means you have to tell the market not just what effect your business has on a particular sustainability attribute, like the environment, so your carbon emissions, for example, but that you then have to explain how your carbon emissions are going to affect potentially the financial profile of the company. So it's a very prescriptive set of rules that I think will ensure that there's a lot of transparency for these bigger companies. And even with the SEC's proposal, once you have companies disclosing scopes 1 and 2, effectively you will get your scope 3 because, that's your emissions through your value chain, so you'll get your customer and your vendor emissions.
Yeah, I think at this point the market wants the clarity. I think it's kind of probably like for the students here, like the moment before the test, like once the test, you sit down and take the test. This is probably usually not as bad. But the lead up. So I think we're all looking forward, and I know the investors in corporate world, like let's have the rules, let's understand them. I think we all want the disclosure to be legitimate and meaningful. Yeah. So the more we have the rules and it's understood by everyone, and you're able, as an investor or a regulator or what have you, to really compare apples to apples, I think it will be helpful.
Okay, great. And Melissa, you're making me feel great about the notes. I put EU, put California, so thanks. I feel like great minds think alike. So let me, I think one of the things that, for me, as someone who thinks about data analytics, that's exciting about at least seeing the disclosure rules, even if there's no scope 3 in, and I agree on like the double counting kind of point with scope 3, does this open maybe a new market for folks like me who like to think, my students who do analytics, do risk analysis? Firms now need to disclose these things. We need to measure them better. So I want to talk a little bit about the challenges associating with measuring and allocating carbon emissions. And kind of high level, is the challenge, we hear a lot of talk about this, particularly from banks, is the challenge more compliance, just getting firms to be kind of honest? Or is the challenge more technical, or is it both? And how do you view that breakdown? And I'll open that floor.
Yeah, well, at the risk of maybe boring the room, putting everybody to sleep, I can tell you that it's, in the process of having to operationalize our climate commitments, there's a lot of really nitty-gritty technical stuff that needs to be addressed. So let me just give you an example. We work with some of the most established data providers in the marketplace around our climate, commitments and our net zero goals and reducing our carbon emissions. And some of the limitations in the data, which underscore the fact that some of the data is not really decision useful at this point, particularly as it relates to scope 3. So I'll give you several specific examples. These data providers don't actually go back and restate historical data for corporate events. So if there's an acquisition, a divestiture, or a spinoff, and they're not going back and restating prior year's data. And all of these reduction goals are essentially versus a baseline in the past. So you're looking at year-over-year changes. And you could be looking at apples to oranges if you're looking at that. Similarly, they don't go back and change estimates that they came up with for the actual data once it gets reported by a company. So increasingly over time, more companies are reporting things, the accuracy of the data is improving, but these, the information is not getting restated retroactively. So that's a data limitation as well. Another example of a data limitation is the fact that there are probably 15 categories of scope 3, and some companies report on all 15, some only on a few. So there's not even comparability across companies within a certain industry. So these are some of the limitations that exist out there, and one of the things that we're doing to address it is we're actually hiring, to your point, data scientists that have specific expertise in this area. In fact, we've got a Duke grad on our team that has an undergraduate BS in computer science and climate analytics.
Fantastic. Love it. Love hearing that.
Yeah, I mean,
Yeah. Everyone approves.
Yeah, I mean, I'm feeling good about at least the trajectory of data.
Yeah.
Like, we're getting more information, and then there's also the way that some of the tax credits are calculated. So it's great to have a stick, like you have to do this, and SEC and what have you. It's also really nice when you have carrots, and one of the carrots is that for a number of the tax credits, you actually have to show your emissions. So a number of companies that we see now starting to, well, first of all, the platform's availability, the data that's coming out of it, the new sensors that are being created. I mean, what's happening in the labs, the 17 national labs in the Department of Energy is fabulous. What's happening at the universities is incredible. And so I feel like we're in a in a right part of the curve as far as getting data and being really able to understand what we're doing. And again, the carrot is by calculating it correctly, you can qualify for certain tax incentives. So you have a lot of companies spending dollars on this, and I think data's only getting better. Okay.
All right, I'm keeping an eye on time here. I'm not going to get to quite all my questions, but let me try to get two more in here if we can. So let me pivot to something broader and kind of the broad landscape of ESG investing. And I know, Melissa, you've spent your entire career, working on this, advancing this. Can you talk a little bit about opportunities and challenges? And of course, I want to hear your perspective as well, Leslie, on that.
Yeah, no, look, I think that we talked a little bit about the macro environment. I think what we saw over the last couple of years is the ESG investing landscape having to adjust to a different macroeconomic backdrop and really having to assess the long-term impacts of a higher inflation, higher interest rate environment on the long-term trajectory of ESG. But our view is very much that ESG is a secular trend. It's not a cyclical one. So we do not believe that what we saw last year and in 2022 heralds the death of ESG investing. In point of fact, we find that there's a tremendous amount of investor appetite for practical approaches that investors realize that these are real things that can impact the financial performance and operating performance of these businesses long term. So they're, I think they're using even more rigor to make these evaluations and assessments, which is probably good for the market. It's becoming more mature. What we think they're most focused on, investors in general, is what we call ESG rate of change. So it's they're looking for alpha creation as a consequence of people improving their ESG profile over time, basically. It's the trajectory that you're on. It's not necessarily where you are today, because that's what creates value over time, in stocks. So it's alive and well.
Yeah, okay, thanks.
Yeah, and I mean, I just want to thank the ESG community for being a leader, first out on this, but really I feel like environmental, social, governance, all these issues have become so much more mainstream. They brought these conversations into every investment committee, every boardroom, every discussion, and so whether it's labeled, not labeled, we should be very appreciative of their leadership, because this has really become much more commonplace. Like, you would never have a conversation about an investment or the risk of an investment without bringing in the elements of ESG. And so I applaud the efforts and hope that they continue, because they make all the investing community, and they start to put a risk weighting on all the externalities of what we're doing, and so super supportive of how they got us here.
Yeah, and coming back to private credit markets, sustainable finance disclosure regulations in Europe, they're talking about private credit markets incorporating ESG practices into probabilities of default, right? And so really interesting to see this become much more kind of codified into things, yeah. All right, last question, and this is, we're here today, we're thinking about, basically what higher education can do, what Duke can do. We're gonna have a great session at the end with Mark Florian and Toddy Steelman, and so I don't want to steal their thunder, but as two Duke parents here, I haven't, among many other accomplishments, I want to ask you kind of, with all your senior kind of like years of experience, professional experience in the private and public sectors, also being Duke parents, if you could point to one thing that Duke could do kind of in the climate finance space, or even more broadly climate, solving climate change, what would it be? I know, big question, but.
Yeah, no, it's a great question. I mean, I think this is what Duke can do. The cross-sectional, climate data, stats, society elements to it. My daughter and now son's experience at Duke has been incredibly multidisciplinary, and the climate transition is really that. And there's no perfect element to it. It's a huge ecosystem that we're trying to get all those elements right. And if you look at the way that Duke approaches the student and its curriculum, I think that in my children's experience, like you guys have all the elements to really help the next generation continue along this path. So couldn't be happier with the way that Duke doesn't prioritize one element, but really thinks about the whole.
Yeah. I echo everything that Leslie said. I think, Duke I've been incredibly impressed with how interdisciplinary the curriculum is here, and, how focused you are on this particular practice. And a case in point is we just hired a woman for the summer who is a graduate student who's getting a degree in environmental management and finance. Carolyn Zapecki, if you're in the audience, come say hello afterwards. But she's literally going to be working for my team this summer as part of our Sustainable Fellows program. I was amazed at the coursework that she's taken. I mean, like geospatial information services or something, and energy and nature accounting. I mean, I never even heard of these courses when I went to undergrad. So I'm amazed by that, and I think that Duke can keep doing that. And then the last thing maybe is on the executive management front. I'm not as familiar with what you're doing in that regard, but I think increasingly, boards are going to have climate expertise, in the boardroom, and making sure that you are educating, C-suite executives and board members, with certifications or expertise, so that they can really have, the SEC's going to require it, essentially, for you to disclose, what's your board governance of sustainability risks, and that's going to necessitate your demonstrating that you have some expertise in that regard. So educating executives.
Fuqua's executive education is getting a lot of calls on that, exactly. So we're working on that, so that's great to hear. So, well, we could talk for a lot longer here, but we need to wrap up. Leslie, Melissa, it's been an honor. Thank you so much.
Yeah, appreciate it.